Welcome to our presentation on Mountain Man Brewing Company. So our recommendation for Mountain Man, it's the absolute time to expand our offerings and launch Mountain Man Light Beer. There's an increased demand in the light beer marketplace, and we want to go after that. Really, our challenge is for the brand, light beer becoming more popular, and light beer really being extremely popular in the prime demographic of younger drinkers between the ages of 21 and 27. Absolutely time and vital for us to launch a light beer for Mountain Man in order to capture that market and continue to have their brand loyalty throughout their lifetime.
Great. So moving into the situation analysis, essentially we are a differentiated brand offering the highest quality lager in West Virginia with really a strong presence in East Central West Virginia coal mining territory. And from a competitive landscape perspective, one of our prime competitors here is Budweiser, both the Budweiser brand as well as the Bud Light. Now moving into our recommended marketing strategy, we really feel that our positioning must remain West Virginia's beer. While we have two products, we certainly want them to be under that one brand, and the emphasis still being on the authentic quality beer for any generation. And you know, Mountain Man was the lager, 80 years of bold and tough lager, and now Mountain Man Light, 80 years in the making, quality light beer. So setting our sight on 2010, by 2010, Mountain Man will have successfully diversified our revenue by product type, and with 60% of our revenue coming from lager and 40% from light beer. How we'll get there? Through activating our sales force, leveraging existing manufacturing process, encouraging distributor promotions, hyper-local activations, and really create an authentic brand communication strategy. And our target market is really the millennial and younger Gen X male and female consumers, ages 21 to 44. The sweet spot is definitely the 21 to 27-year-olds, but we feel that our market will skew a little bit older as well. We want to get those slightly older consumers in there. And our challenge is really to remain authentic, not corporate, and stay true to our Mountain Man philosophy. And remember, our loyal customers, light may not be for them, but Mountain Man still is. We'll get there by expanding on our strong brand equity to create an authentic and relevant brand community for a younger consumer. And then moving into marketing tactics here, as you'll see, our recommendation is for a really aggressive 6-month media support for the launch. And we'll position these over the summer months and football season to really capitalize on those barbecues and games. So from June through October, we'll have two messages in market at the same time, actually. So one will be an overarching brand message for Mountain Man brand, and this will help us minimize alienating existing customers by reinforcing the brand they know and love. And the Mountain Man Light will have support in TV, radio, local print, and targeted digital and paid social. And then beyond that, we'll lighten up and pull TV out unless there are opportunities around certain media events like the Super Bowl. And then here you can just see the launch plan by tactic. The one additional thing I want to emphasize here is really important for internal buy-in. So with the employee and sales force, we really want them to embrace this new brand, the Light Beer brand, and really be able to champion it. So we'd have a kickoff in the May timeframe before we launched. And then here, just a quick snapshot at our advertising budget. So again, the aggressive launch, we feel that we need $750,000 to attack this. And here's a quick look at our allocation through spot TV, spot radio, local print, digital, and paid social, and then also the off-premise distributor promotions and the employee kickoff.
So taking a look at the financial projections that helped us with our recommendation, when we first started this, we wanted to look at two financial hurdles. The first one was, could we introduce a product that would have positive cash flow by year 2? And could we also introduce a product that would overcome any losses from the lager product line by 2010? So using those two financial hurdles, we looked at some guidelines and some assumptions. The lager product line had been declining by 2% yearly, and we also wanted to factor in a 10% loss in 2006 with the launch of the light beer. Our 10% is a conservative estimate based on our strong marketing initiatives that Heather just talked about. Our light beer product line would target a market share of 0.25% in year 1 and continue to grow by 0.25% yearly. Our final target would be 1.25% market share by 2010. And our light beer would sell for $97 per barrel, which is the same as our lager, and that total industry barrel growth of 4% yearly for the light beer. The total industry barrels was tied to our market share, and that's what we use for our assumptions forecasting our revenue. On our next slide, we'll see our full 5-year forecast. Quickly looking at this, you see the total revenue growing from $50 million up to $68 million with the addition of the light beer sales. And you'll see the corresponding expenses that go with that. The yellow line on the bottom is our net income. So you'll see by 2010, we're expecting $5.6 million in net income. Now taking a look at the profitability analysis, going back to our initial first two hurdles, we wanted to have positive cash flow from the light beer by year 2. So you'll see the net cash flow from light beer line, and by 2007 you'll see we have positive cash flow. Also, we wanted to overcome the negative impact from the lager. So we had a 10% loss factored in 2006, which was a loss of revenue of $5 million. But that orange line, you'll see we have break-even cash flow from the light beer sales of $4.6 million by 2010, therefore accomplishing both of our financial hurdles. And because of that, we went forward with our recommendation of the light beer product line. So some other financial and strategic support that we came up with along the way, as well as the diversification of revenue that we mentioned earlier. 60% of our revenue come from the lager, 40% from the light beer. This will allow Mountain Man to be more agile and quickly adapt to any changing demographics by year 2010. We'll also see increasing margins. Profit margin will increase from 6.18% in 2005 up to 8.21% by 2010. Additionally, we'll also see pre-tax and expense margins expected to improve during the same time frame. And finally, profitability. If we look at internal rate of return, it's very strong at 20.78%, suggesting this is a strong profitability product launch for us. Now taking a quick look at implementation controls, we set out some guideposts for year 1, things we want to monitor. First thing is gain market share. We have expectations to grow our market share by 0.25% yearly, finishing at 1.25% in 2010. So we'll take a look at that in year 1. Also, we want to monitor brand sentiment, and we want to monitor our quarterly loss to maintain that both products are moving forward positively and we don't exceed our 10% loss that we factored into our financials. Also, we can look back and review the price point for both the light and lager beer, and we can adjust that barrel per the barrels that we're selling at $97, either up or down based on market demand. And finally, we can assess our marketing mix, and if we realize that TV is beating out social, we can adjust our budget and move forward in year 2 for that. Well, thank you all for listening to our presentation. We hope you enjoyed it.